Welcome, everyone. Let's dive into crypto to crypto trades and the taxes that come with them. It's fascinating how the IRS treats these as taxable events, right?
Yeah, absolutely. Every time you swap one cryptocurrency for another, it's like you're selling one asset to buy another, which triggers a capital gains event.
Yep, exactly. And that means whether you're swapping Bitcoin for Ethereum or trading any altcoins, it counts as a sale. Even if you think you're just switching toys, the tax guy is watching.
It's almost like exchanging baseball cards, but with much higher stakes and tax implications.
Right? And the IRS treats crypto pretty much like property. So, like, you have to record your initial purchase price, the cost basis, and then the fair market value at the time of trade. That difference gives you your gain or loss.
Yep. So essentially, if your asset went up in value, the gain is taxable. And if it dropped, you could even use that loss to offset gains elsewhere.
Totally. And it doesn't matter if you've held it for less than a year, in which case it's a short term gain and taxed as ordinary income, or over a year, which might get you long term capital gains rates.
I always find it interesting, how timing plays such a huge role in your overall tax liability.
Yeah, timing's everything. And speaking of taxable events beyond the basic trading, don't forget that mining, staking, and airdrops are treated differently. Those are considered ordinary income when you receive them, based on the
Right,
fair
exactly.
market value at that moment.
So you could be trading crypto to crypto 1 minute, and then later, your rewards from staking add an extra layer of taxable income on top.
Absolutely, it's a bit like juggling multiple balls. Each one needs to be accounted for separately. And then there's the fact that holding or even transferring crypto between wallets isn't taxable at all, which might, give some relief amid all this complexity.
That's crucial to point out. Right, so as long as you're not disposing of the asset, like you're simply moving it around, it doesn't count as a taxable event.
Precisely. It's only when you sell or exchange your crypto that the tax liability kicks in. Now let's talk about calculating these gains. Imagine you bought one Bitcoin for like $10,000, and then later you swapped it for Ether when Bitcoin was worth $60,000. That $50,000 increase is your capital gain.
Yep, spot on. And depending on your income, that $50,000 could be taxed differently if it's short term versus long term.
Exactly. Short-term gains fall under ordinary income rates, which can go up to 37% in some instances, while long-term gains might be taxed at 0%, 15%, or even 20%, depending on your overall taxable income.
It's almost like a sliding scale depending on how long you hold and how much you earn overall.
Uh-huh. And, something that sometimes gets overlooked is that crypto to crypto trading itself gets tracked meticulously. The IRS even uses blockchain analytics to pinpoint tax evasion, and they've already seized billions in crypto assets.
Wow, that's intense. So, even if you think you're just trading coins, there's a whole network monitoring this to enforce
Absolutely.
compliance.
True. And apart from the basic tax calculations, there are several strategies folks can use to try and minimize their tax liability. For instance, using tax allowances, holding for the long term, or even donating crypto to charity.
Right. Yeah, I read somewhere that donating crypto can be tax free in the US up to a certain amount, like $17,000, which is a neat benefit if you're philanthropically inclined.
Exactly, and spreading out your trades over multiple tax years is another clever strategy. It's like pacing your gains so you can stay within a lower tax bracket.
That makes sense. Though I must say, I sometimes wonder if these strategies, while legal, could be seen as too close to, moving the boundaries of tax planning.
That's a fair point. I mean, it's definitely a fine line between smart tax planning and outright avoidance. The intent should always be compliance with the law without slipping into aggressive tax evasion tactics.
Exactly, compliance is key. And speaking of compliance, the penalties for not reporting these trades right are no joke. Fines, interest, and even criminal charges if you're really off the mark.
Yep, absolutely. If you don't report crypto trades accurately, you're basically asking for civil or even criminal penalties. Imagine the Bitcoin Jesus case, where a man faced evasion charges for $50 million in tax
Incredible
payments.
indeed.
And that case totally underscores the importance of keeping detailed records. Every trade, whether it results in a gain or a loss, needs to be documented meticulously.
Right? Those records are your lifeline during tax season, not just the trade details, but also the associated fees. Everything adds up.
Exactly. And with platforms like CoinMarketCap or CoinGecko to verify fair market values, it's become slightly easier, though still a tedious process for many investors.
Tedious but vital. I also noticed something interesting. Using crypto as collateral or for gifts usually doesn't generate a taxable event. That's a bit of a relief compared to triggering a sale.
Right, transferring crypto between wallets or using it as collateral doesn't count as disposing of it. It's really just when you actually convert it or use it in a purchase that the tax kicks in.
Exactly. And even gifts are tax-free up to a point, though you need to be aware of the giver's cost basis and subsequent holding period.
For sure, this is really an ecosystem where every move matters. It's like navigating a minefield, where one wrong step sends off a tax alarm.
Absolutely, a careful strategy is essential. And what about crypto taxation software? I've heard those tools can simplify record keeping and help you identify deductions you might miss otherwise.
Oh yes, specialized crypto tax software is a game changer. It helps track every trade, fee, and income event automatically, which can really ease the burden during tax season.
Yep, that sounds like a smart investment.
Also, there's a neat trick some investors use called tax loss harvesting. Basically, selling some assets at a loss can offset gains from other trades. It's strategic like a chess game.
Interesting. But don't you think that if someone constantly does this, it might trigger an audit? I mean, there's a balance to strike, right?
You raise a good point. Overusing tax loss harvesting can indeed raise red flags if not handled transparently. It's all about striking the right balance and making sure everything is well documented.
Yeah, balance is crucial. It's a delicate dance, definitely. And then, of course, there's the issue of global variations. While these rules apply in the US, other countries might have a totally different approach to crypto taxation.
Exactly. So if you're trading internationally, it's important to check local regulations. Some might treat crypto as currency rather than property, which changes everything.
Right, a vital detail for global traders. To sum it up, every crypto to crypto trade is a taxable event in the US, and staying compliant requires thorough record keeping and an understanding of various tax strategies.
Absolutely. And embracing the complexity with good advice and reliable tools can make tax season much more manageable. It's like turning a potential headache into just another step in your trading strategy.
Yeah, exactly. Well, it's been a deep dive into crypto taxation, and hopefully our chat sheds light on why every swap matters.
Definitely. And whether you're dealing with mining, staking, or just plain trading, knowing the tax impact is crucial. Thanks for joining this discussion. Stay savvy, keep tracking, and trade responsibly.